The electric vehicle market is experiencing a surge in interest, fueled in part by government incentives. One significant incentive is the $7,500 federal tax credit, designed to make EVs more affordable for American consumers. This tax credit, introduced as part of the Inflation Reduction Act, aims to accelerate the transition to electric mobility and reduce carbon emissions. However, navigating the requirements to qualify for the full credit can be complex. Not all EVs are created equal in the eyes of the tax credit. The criteria for qualifying can be quite stringent and detailed. To qualify for the full $7,500, a vehicle must meet specific criteria related to battery capacity, assembly location, and material sourcing. This means that not just any electric vehicle will do. It has to be one that meets these precise standards. For example, a significant portion of the battery components and critical minerals must be sourced from North America or countries with free trade agreements with the US. This ensures that the materials are coming from reliable and approved sources. These requirements are intended to boost domestic manufacturing and reduce reliance on foreign supply chains. By doing so, the aim is to create more jobs within the country and ensure a more stable and secure supply of essential materials for electric vehicles. A provision in the Inflation Reduction Act has created a leasing loophole that makes leasing an EV particularly attractive. This new provision is designed to encourage more people to switch to electric vehicles by making them more financially accessible. This loophole allows consumers to qualify for the $7,500 tax credit, even if the vehicle itself doesn't meet all the requirements for purchase. Essentially, it opens up the benefits of the tax credit to a wider range of electric vehicles, making it easier for families to afford an EV. Typically, leased vehicles are treated as commercial vehicles, which are subject to different criteria for the tax credit. This means that businesses and individuals who lease electric vehicles can take advantage of the tax credit in ways that were previously not possible. Under the new rules, if an automaker leases an EV, they can claim the $7,500 credit even if the vehicle wouldn't qualify for a consumer purchase. This has the potential to significantly boost the electric vehicle market, making EVs more accessible and affordable for a larger segment of the population. Section 4. EV. Leasing takes charge. The loophole's impact. Since the implementation of the leasing loophole, there has been a noticeable increase in EV leases. Consumers are drawn to the opportunity to access the tax credit benefits without having to meet the stringent requirements for purchase. This has created a win-win situation for both consumers and automakers. Consumers enjoy lower monthly payments and potential tax savings, while automakers see increased demand for their EV models. Section 5. Automakers embrace the leasing advantage. Automakers, particularly those with production facilities outside North America, have been quick to capitalize on the leasing loophole. This approach has allowed them to navigate complex regulatory landscapes and maintain a strong presence in the market. Companies like Hyundai and Kia, whose EVs are primarily manufactured in South Korea, have been promoting lease deals that highlight the availability of the $7,500 tax credit. These promotions are designed to attract a broader range of customers who might be hesitant to purchase outright. This strategy allows them to remain competitive in the U.S. market despite their vehicles not meeting the sourcing requirements for the full purchase credit. By focusing on leasing, they can offer attractive financial incentives and make electric vehicles more accessible to the average consumer. This not only boosts their sales but also helps in promoting a greener, more sustainable future.